Bank, HDFC Bank, cut its base rate last month by 35 basis points to 9.35%. This is one of the steepest standalone rate cuts by HDFC Bank in recent times and means that the bank now has the lowest base rate amongst all big lenders. CNBC TV 18's Latha Venkatesh caught up with the MD and CEO Aditya Puri. Here's a slice of that conversation.
The base rate is calculated as a function of your cost. The cost can either be average cost or it can be marginal cost. The RBI in their circular said we encourage and advise the banks to move to marginal cost. Recognizing the RBI English, I figured this was a direction that you do it yourself or we'll tell you to do it. So we were one of the few banks that moved to marginal cost.
Okay.
When I review my base rate, it's a function of the marginal cost. The cost of deposits has come down. I reduced my base rate.
Okay, so you would reckon that if the system moved in April 2016 to marginal cost, yields would, lending rates would fall by about 30 basis, 35 basis?
I don't know the exact amount, but they would have to fall.
Okay.
Because our deposit rates are almost the same as everybody else.
But you could have waited for April.
No, you have to review it every quarter.
Okay. Yeah, but they did give you time to get to marginal costing by April.
Yeah.
So there is definitely another reason why you must have advanced the marginal cost calculation. It's going to give you an advantage in the market, won't it?
We are a good boy. The regulator said we did it.
Okay, what advantage will it give you in the market? How much are you estimating you will be able to make up in volume what you may have given up in margin?
See, the point is that obviously we do believe that the rest of the market will also cut. More than the advantage in the market, the reality is with the demand and supply for money, interest rates, I can tell you, will go down further even if the RBI doesn't cut the interest rate on 29. I can assure you before you go into the next year, there will be further cuts in interest rate. The fact that incidentally, like they say, collateral damage, if people don't match us, obviously enlightened self-interest would say that the corporate should come to us before they go to anybody else. But what I want to clarify is that this was not done as a predatory measure.
Okay.
This was done because we are a good boy and we go by what the regulator wants and what the country wants, i.e. quick transmission of interest rates so that we can have an uptick in the economy.
Okay, this is leading to several questions. One, you said cost will fall anyway, the cost of money. How much do you estimate things can go down by? Another half a percentage point?
I think so.
More?
I think so, yes.
More?
Yes.
Why don't you give me your number? What might be?
How can I give you the number? As I told you, this is elementary mathematical calculation.
Yes, that is the 35. But
if you notice, I have reduced deposit rates after the cut as well.
Yes.
So the next time I review the base rate, by definition, it'll have to be cut.
No. My point is, if you're looking ahead at the absence of demand, as well as the way inflation is trending,
if everybody moves to marginal cost, and if RBI helps as well and cut, you could look at between 50 and 75 basis points.
Before the 2015 year is out?
Before the fiscal year
is out. Okay. How much do you think this is helping volume? Are you already seeing it? Because if I were a customer buying a car or anything...
We are seeing improvements in volume.
Okay. Last year, I think the first quarter you all said 22% year-on-year growth in credit.
Yeah.
This year you will expect that it's going to be a lot better?
It should be better as the economy is picking up.
Okay. No, but you also have a price advantage. Won't that anyway mean that you will do better than last year?
Now, what if everybody reduces the rate by month end?
Okay. Okay. Now, you were speaking about the economy.
Yeah.
What is your sense? Have things gotten a little worse in the current quarter versus the previous because of monsoons or for whatever reason?
I don't think so. I don't think so. You see, there are a lot of things that people are talking about which is not necessarily the reality that we face on the ground. The economy is on an uptick. So let's be very clear on that. And this inflator and deflator and all this is confusing everybody. But the fundamental is that the economy is on an uptick. People's expectations of that uptick vary, and consequently so do their observations. But we continue to hold that somewhere between 7.4 and 7.6 GDP will come this year. We're also seeing a lot of government expenditure come in this quarter. And even if you take the previous quarter estimates and you bring in government expenditure, any slowdown or any perception of that would probably be misplaced. Okay. So we think there will be an uptick in the GDP growth rate. It may not be to the level required. And let me preempt your next question. When will private investment come in? I think we have savvy businessmen. And if they see a continued uptick in the GDP, the investment will follow. Before the delta of the investment hits the GDP, in our own mind, it's somewhere between 12 to 18 months.
Okay, actually, my question was slightly different. You know, when a man with 4,000 branches in 2,500 cities cuts his rates, and when I ask him about demand, I'm also asking you whether you can see it, whether you can feel it in the bones. Are your branches telling you that things are on the mend or are at least not deteriorating?
Our branches and our figures are telling us that GDP is on an uptick.
Okay, that's very positive. So what do you make of this NPL situation? Do you think that things are not getting worse? Or do you think that in several pockets they're getting worse for altogether different reasons, global reasons?
That's a lot of questions in one letter. Let me backtrack.
Okay, how will the NPL scene look to you?
Yeah, let me come to NPL separately, because as you know, I don't have too much, and I'm consequently not the best expert on it, as a neutral observer. Now, we are looking mostly on the negative side. Now, let's take the Fed rate cut, Fed rate increase. When you take the Fed rate increase, everybody is talking about increase in the interest rates and how it will affect loans. But the fact of the matter is, interest rates get changed for two reasons. One is a change in the real economy, and the other is a negative change when it's consequent to a financial shock. If it's because of a change in the real economy, there is also a positive side of the US, which is the largest industry country, doing well. And when you have that, with a lag, when people understand that, actually the risk on comes in and you get money into the emerging market. I think the issue on China is also overdone. Okay. If you see my old friend Stephen Roach, he has said clearly that China, even when I had gone for a Deutsche Bank conference there, has been trying to move from an investment-led growth to a consumption-led growth. And they have actually succeeded quite well. Their consumption figures are upwards of 40-odd%. And so will there be an engine of growth? No. But will their economy continue to grow without upsetting all prices all over the place? Yes. So are global factors negative to some extent? Yes. Are they positive for India? All the FIIs think so. Yes. Because of the commodity cycle, the fact that we've got excellent exchange reserves, we are not that dependent upon exports, and that could be an opportunity as well. If the currency devalues, we may be more competitive. Okay. So I do believe that with the, what I said, uptick in GDP, plus where we are on the mend and moving forward.
That's very good to hear, but only to get it back to the NPL issue.
I'll come to
there is a problem of Chinese dumping. Okay. So do you think that has stressed the situation more?
Yes, in steel it has definitely stressed the situation because they are really dumping and something will have to be done. But going back to the NPA situation as well, if you lump all NPAs stroke stressed assets in one bucket, I don't think it's right. Okay. There are a lot of them that will solve themselves with the uptick in the economy and the release of government expenditure. There are a lot of those places where between the promoters and the project, you may have created unviability. Okay. Those will require some tough action. But those are not so large as to affect the banking system. I think the FM statement is there this morning. Those are not so large as to create a systemic risk. But we need what is going on. And if you see Dr. Rajan, he's been talking about a Chapter 11 kind of law whereby we actually turn these things around. So my own view, yes, there is strain. It is not a systemic risk, but it needs concerted action.
Again, this is not your kind of problem, but banks can, lend loans for 25 years by only giving a first initial 5-year commitment, that 525 loan. And the refinancing of that loan also comes with a clause that we can take it over if you don't service the loan properly. Do you think this clause of loan conversion into equity will be used effectively? Is it, a weapon enough in the hands of banks?
See, Latha, this is the classic case. No, this is the classic case in India. If people follow why it has been introduced with integrity, it will solve the problem.
Okay.
If people fool around and start putting the entire ballooning at the end, and yet have a situation where NPV comes out right, so the intention of the RBI is good. The end result, if properly administered, is good. But if you apply this to a fundamentally unviable project, then it's bad.
Yes, sir. I can see that, but we are only seeing early instances of that weapon being wielded, not entirely being used. Mr. Puri, just to come back and finish your, base rate cut question, will there be a sacrifice of margins for the second half of this year?
Our margins are always within a range. So if you're asking, could there be some minor hit on the margins? Yes, 2, 3, 4 basis points possible.
That's all.
Maybe 5, I don't know. But our margin, we always say, is in the range of between 4.2 and 4.4. Is that construct intact? Absolutely.
Okay. Even after this cut, you go above 4.2. That's big.
We don't give forward guidance, but I'm saying it will be in the range.
That is Mr. Aditya Puri saying that his branches are telling him GDP is up. Forget the deflator, forget all the confusion around the first quarter numbers. This economy is on an upswing, and you can catch that entire conversation at 6:30 p.m. this evening. Don't forget to catch it. That's a special telecast of Indianomics that's coming